This week, we are coming out with two interesting webinars. The first webinar is The Secret to Long-Term Wealth, where we discuss on the behavioral aspect for long-term wealth generation. And the second webinar is The Impact of Tariff in Indian Stock Market, where we discuss the current issue of US-India tariff situation. To join this webinar, click the link below.
I'm going to talk to you on the topic investing smartly in bear markets. When you see a long bear market where selling happens all the time, the markets hardly show much enthusiasm. Interest to buy is much lower. That should be seen as an opportunity, and we all know it. But as a professional advisor and manager, I also see how investors react from the other side. Generally, investors tend to become more anxious in bear markets. First, they are not sure if their portfolio is positioned correctly. Second, they are confused whether they should invest now or later. They also don't know whether they should invest less now or more now. They also are not too sure whether equity is the right asset class. All this is caused simply because everything looks gloomy, everyone around is fearful, and selling is what they see. Stocks always tend to go lower. This is classic bear market behavior, and this is what investors have to overcome. What I have seen is that a small set of investors actually overcome it. So let me tell you what I liked about this small set of investors who come with great conviction. First, they simplify their investing. Second, they know that results are not something they should bother about in a bear market, because the time to judge results is in a bull market. You need to invest through bear markets, and they know it. Now, how do they carry their conviction forward? What do they do right? That's what I am going to tell you in this video. This small band of investors do a few things right, and they do it consistently right. First, they invest monthly. Every month they know what is their saving, and they invest that saving into equities. They also know that this discipline should never be broken. So, monthly investments hit their investment account. That's the first thing. The second thing is they make lump sums during big falls. If the market falls big, they make a lump sum investment. This investment goes in at a time when they're selling all around. Stocks which they want to buy trade at depressed prices, and they are able to build positions easily without disturbing the price. In fact, they end up buying cheaper than they actually wanted to or would have liked to. The third thing they do right is that they try and raise their monthly installment. Investing monthly is one thing, but that's almost a fixed sum. Most people try to double up. These are smart people who know that when sentiment is depressed, when markets are bearish, they should actually do more. But what if their financial means are somewhat limited? What if they don't have liquidity to invest in equities? Smart investors find a way out of everything. Sometimes they change their asset allocation in bear markets. Let's say you have an asset allocation of 60% debt and 40% equity. In a bear market, these investors reduce their debt allocation by 10% and increase their equity allocation by 10%. That makes a significant difference to their outcome, and by showing conviction when valuations are in favor and nobody wants to bet on equity or everybody is running scared, these investors improve their outcome. They're able to get better results by changing their asset allocation and improving their performance. So that's the fourth thing. Lastly, the smarter investor always smells opportunity. He knows that when everybody is selling, he must buy. He sees all round selling as an opportunity. He knows that when markets are extremely depressed, he should not be wasting time on performance. The most important thing about a smart and astute investor is that he puts opportunity above performance when markets are extremely bearish. He knows there's no use checking out on performance at that time. Instead, if he focuses on opportunity, performance would automatically flow into his portfolio when markets stabilize or go to a better place. So 5 things which smart investors do all the time. They invest monthly, they make lump sums during big falls, they raise their monthly installments, and they also change their asset allocation at the right time, and lastly, they put opportunity above performance. So if you would like to join this band of smart investors, try and bring these habits into your investing. Do a few things right, a few things more, and take that extra effort to make performance your fellow traveler in your investment journey. Happy investing. Thank you.